Thank you. Really what you see up on the board is financial integration. It's an integration of multidisciplinary approaches to solving the asset pricing solution. Okay, and it's multidisciplinary. From the macro view, I usually solve things from the macro view, and then I drive down into the micro. Okay, so you have to start from the macro and the macro environment. That's going to be monetary policy and open market operations. Monetary policy is basically the economic regime that oversees the economy and the capital markets. The tool in which the Federal Reserve utilizes, the main tool, is open market operations. So to enter the bond market, the open market in the bond market, the Federal Reserve basically has the means to buy and sell bonds, to drive bond prices up and down, to drive interest rates up and down, and to regulate not only the economy and its business cycle, but also regulate asset prices. Okay? Then, from the manipulation and management of the interest rates in the bond markets, interest rates are then determined. Interest rates are then reflected along the yield curve. The yield curve in its dynamic form basically determines the cost of capital and required rates of return in the capital markets. As those required rates of return and costs of capital move up and down, it also determines the cost of debt and the cost of equity. A combination of the cost of debt and equity determines the discount rate. As discount rates go up and down, asset prices go up and down. Uncertainty embedded in interest rates and the yield curve creates volatility in the costs of debt and equity and expected rates of return on debt and equity. Those uncertainties, again, creates volatility. That is risk in its basic form, and we are risk averse, therefore we need to manage the risk or take advantage of it depending on who we are as investors. So why don't we stop it right there, because that was just an introduction, and then what I'm going to do is I'm going to jump